You're listening to Off to Market with Scott Farley and Hamish Chadwick.
I'm Scott.
And I'm Hamish, and we've got Paul back again this week, and we're going to be talking to him about the intricacies of business valuations. We'll get straight into it. Now, Paul, can't we just use our accountants to help us provide a valuation on our business, and why wouldn't we do that? I mean, you touched on that last time. What can you tell us about valuing your company?
Well, if you're valuing there are lots of different methods of valuing. Sure, you can get your accountant to do it. Depends what the purpose for the valuation is. I do a lot of valuations, somewhere between 25 and 50 a year. Some of those are for the family court, and I'll talk about that in a minute. But just a general valuation of businesses. There essentially are two different ways of doing a valuation. One is where you value, if you have a private company, you value the shares in the company, and that is usually done by accountants, and it's called DCF, discounted cash flow method, and it's what accountants get taught at accountancy school, if you like. It doesn't relate to the market. The other way of valuing is by capitalisation and future maintainable earnings, which is basically pricing the business at what the market would pay for it. And that's usually done by business intermediaries or people who are in the business of selling businesses. There's a big difference between the two methodologies. When you value the shares of a company, you take into account the liabilities, so any loans, that sort of thing. When you value the plant and equipment, the tangible assets of the business, you're valuing them, if you're doing it by the DCF method, the accountancy method, you're valuing them at the written down value on the company's plant and equipment. So let me give you an example. I did a valuation recently for the family court. The written down value, it was a bus company, the written down value of the plant and equipment, which was 3 buses, was $230,000. Now I know, because I also do valuation of plant and equipment, that each one of those buses when sold on the open market second hand, would be valued at $250,000 each. So the difference between the two valuations, one $330,000, the other $1.2 odd million. So that's the difference between the two. Secondly, when you do it by the DCF method, the accountancy method, the only statistics that you have are those that are publicly available. That is the stock market, which is also values the shares of companies. So all the risk assessment is done around the stock market, and it values the business, your small to medium business, values it on the basis of what's happening to the whole economy. When you look at a market-based valuation, it values it more specifically against what the market will pay in that particular industry. So a market-based valuation can fluctuate a lot more than an accountancy type valuation, but in work that I do in the family court, the two values are very different. In that case I was talking about, the bus company, a forensic accountant valued that business at minus $496,000. How you get a minus value for a business, I have no idea. Well, I do in that instance, but that's another story. But my valuation was $760,000 odd, I think, plus. So there's a big difference between the two. So the valuation, the methodology used is really important, depending on what you want the valuation for. That'll be the first thing. The second thing is that there are two, if let's say you want the valuation for selling your business, because, for example, there's a life event that occurs, you get sick and you can't carry on with the business, you want to sell it, or you're burnt out or whatever, and you have to sell it quickly, which is not the ideal, of course. When I put my selling business hat back on, you really want to plan this 3 years in advance. But if you have to do it very quickly, and you want to do it by the market, then the market will decide what price your business is worth. And there are a range of values that the business will sell for if you don't put a value on it. If you just go to the market and say, here's my business, what's it worth? It'll be worth different things to different people, and they'll have quite a broad range of values, and you probably will be surprised at what it's worth to some people compared to what it's worth to others.
Sure. No, I'd also like to just add here that Paul is the former president of the Australian Institute of Business Brokers. So although he's saying that you shouldn't necessarily use an accountant for a valuation, it's not a dark art. It's actually a very important field in its own right. Paul, can you tell me a little bit about the work that you did at the AIBB to further the valuations or the knowledge and processes of business valuations?
Well, when I was president, I think it was maybe the last year, I was president for 3 years, and we have around 330, I was doing mostly small businesses at that time, 330 business brokers around Australia, and they facilitated the transfer of around $2 to $3 billion worth of small to medium businesses each year. So the limiting factor is quite often there are disputes in the value of a business, and what the courts look for particularly is other transactions of other businesses that are similar to yours. Now obviously accountants don't have databases of businesses sold because they're not in that business, and we were ideally placed at the Institute of Business Brokers to set up a database, which we did. BizStats it's called. Those types of databases are widely used in the United States, so that you can compare the values of businesses that are recently sold to whatever it is you're selling to justify it. When it gets to court, that's really, really important, because you're not saying to the judge, well, I've been valuing for 20 years and I think it's worth this, and that's your proof source. You're actually saying, here's a bit of paper that says this one, which is very similar, sold for this amount, here's another one, we reckon it's worth this, and 9 times out of 10 the judge will say, yes, we'll accept that, because they're real facts, not just an opinion.
Okay, and just for listener benefit, who can access this BizStats database?
Well, the only people that can access are members of the Australian Institute of Business Brokers. So if you've got a small business to sell, I would urge you, even though I'm not involved with the organisation anymore, I would urge you to go to one of those people and talk to them about valuing the business. Certainly I can access that database if need be, but so can all those other members, but particularly not accountants. And that's why we get wide-ranging views from accountants who either value the businesses too much and they'll never sell, or they value them too little and you leave a lot of money on the table.
The valuation's obviously related also to your first 4 steps as well. If you've got all these things in place, the value's going to be higher.
Absolutely.
One question here, and this is more of a personal thing that happens in some partnerships. You have a technology startup, everything's rosy, no one looks at the negatives. One of the partners has a divorce, and there can be effects, because the partner's got rights over part of the business. Is this something you should take into account when you're setting up the business? In your shareholders agreement, or in the company structure, or in some other manner?
It's better to do it in the company structure, that let's say there's 2 partners in it, they both have the first right of refusal on buying the shares if there is some event that occurs, because that can be quite difficult, because then your business, if you're the partner staying in, can get dragged into this divorce.
And it could affect the sales value of a company, because if the structure's not correct and it's vulnerable to those sort of attacks,
it's hard to do
within the sales period. You could end up.
Well, it's very hard to do a market valuation in a circumstance like that, because what we're really saying when we talk about a market value is, look, we've got this business, we stick a for sale sign in it, how much will somebody pay for it? as opposed to looking at the shares of the company. And there are all sorts of things that can be done when you're looking at the shares of a company in terms of, I guess I shouldn't say fiddling with the balance sheet, but you can do that and to give a picture that favours your course, your desired outcome. Whereas the market's pretty plain and pretty clear. It is what someone is willing to pay.
Yeah.
Okay, thank you, Paul. That was really good. And next week we'll be talking to you about cyber security.
Thank you, Hamish.
Thanks, Paul. Thank you.
You've been listening to Off to Market with Scott Farley and Hamish Chadwick.